In a tumble from Tokyo to New York, so is the market waking up to inflation? Government bond yields around the world have spiked this Monday morning, with 10-year Treasury yields up more than 20 basis points in a week and Japanese yields hitting their highest on record. The reason is that markets are now pricing in a more than 50% chance the Fed hikes rates this year and a rate rise from the ECB as soon as next month, after inflation numbers around the world came in hot last week and the Strait of Hormuz shows no signs of opening. Russ Moll is investment director at AJ Bell. Russ, energy analysts have been saying for weeks that shortages in the oil market were coming and that would cause an inflation spike. But why do you think the bond market seems to have only just realised now?
Well, I think they're probably taking their cue from the equity market to some degree and hopes that there would be a speedy and peaceful resolution to the conflict. Now that we're into nearly week 12, I think it is, those hopes are starting to fade a little bit. And there wasn't anything much came out of the President Trump, President Xi summit last week in China, when there was again a hope that, given that China's been a big buyer of Iranian crude, that there would be some form of leverage somewhere to get something done. Doesn't seem to have happened.
Do you agree, though, with the diagnosis that major central banks are going to be forced into a hike, since, after all, that can't bring oil prices down?
No, it certainly can't, and nor can they print oil either. But I mean, so that's another challenge for them. I guess the issue is that for the US, the Federal Reserve, its call in 2022 that inflation will be transitory is proven to be completely wrong. Inflation's come in on target, I think, once in 1 month in 5 years. So human nature being what it is, there's always the possibility, having got it wrong last time, that they compensate or overcompensate this time. And that may be one fear that they've got. Plus, Mr. Walsh, the new Fed chair, is publicly critical of quantitative easing and expansion of Fed balance sheet. So if he looks to do something about that, that could be a further challenge for bond vigilantes to think about.
Is it a question of his credibility then, if they are prepared to hike when we know it's not what he wants?
He's got a very difficult situation because somebody in the White House will probably have an awful lot to say about the trajectory of policy and probably won't be too pleased to see the markets pressing in a 0% chance of a rate cut this year. But there are other issues. The US debt is a major problem. It's a big problem in Japan. It's a big problem in the UK, regardless of who happens to be Prime Minister or Chancellor of the Exchequer. And there are these similar issues are out there. Inflation in the US, UK, Japan, debt, US, UK, Japan, and in the UK, some political instability on top down. In the US, we have midterms, so let's see what they bring.
Highly priced stock markets, especially in the US, still don't really seem to be pricing in the biggest disruption to oil supply in history or the inflation that would go with that. But are these bond yields now going to be a wake-up call for equity markets?
Rising bond yields were a big problem at the start of the decade for growth stocks when interest rates started to go up. You did see some of the Magnificent Seven go down 30, 40, 50%, and a lot of that is just mathematics. Higher bond yield means higher discount rate. Higher discount rate in your discounted cash flow means lower future cash flow valuations and lower theoretical equity valuations. It's just maths. So it is intriguing that the Mag 7 have managed to shake that off so far. Let's see if there's a trigger point on the bond yield that makes people reassess, or a good old-fashioned earnings disappointment, though I suspect we probably won't get one of those from Nvidia this time around.
Well, as you say, those tech stocks have kept on moving higher after those earnings, but this week we get results from the world's most valuable company, Nvidia. How high are market expectations?
They're pretty high, though. Mr. Wang, the chief executive, is pretty good at managing those expectations, and when he gave guidance for Q1 alongside the Q4s, the sort of worked out consensus of $1.77 a share came out flat on the fourth quarter. I think people will be looking for more than that. And again, they'll be assuming that he sandbagged the numbers. Maybe the guidance for Q2 will be more important when their guidance is for $1.92, or certainly consensus is for $1.92 a share.
You think investors will be looking for more than that? What if they're disappointed?
Well, I suspect, yeah, if they are, I mean, there's always the whisper number bubbling around out there, which will be a little bit higher than that. I think if you're looking at fundamentals rather than just street corner gossip, you've always got to go to the balance sheet. The company's inventory days have been going up. Inventories have been rising faster than sales. So that's always potentially a flag. Receivable days have not, however, so that's a good sign. But if there are any signs of difficulty, balance sheet first, cash flow second, P&L third.
That was Russ Mould of AJ Bell. Don't forget, you